Let me show you two news headlines I recently came across. So number one from CNBC, quote, the S&P 500 and NASDAQ closed at new records lifted by the tech rally. And number two, more than half of Americans say they're living paycheck to paycheck. What's crazy is that both of these headlines are true. Neither one of them is a lie. There are actual reasons as to why they both can be true at the same time. And by the end of this video, you'll know exactly why this is happening and what you can do about it with your money. Now, I want to start this video off right away, debunking a very common myth you might see online. And that myth is that the stock market is equal to the economy, but this in fact is not true. Because the question people usually ask is, how can stocks be at record highs when everyone is struggling? This question inherently assumes that the stock market measures the economy. The reality is that the stock market has never measured the economy, and people will use these terms interchangeably, but that is incorrect because the stock market only measures what expected future profits of corporations are. If you're talking about the S&P 500, then we're really only looking at the expected future profits of the top 500 largest corporations in the United States, and that's honestly it. So think about everything that the stock market doesn't measure then. It doesn't measure the price of eggs, the price of rent in your local area, your wages, and how hard it is to find a job. The University of Michigan Consumer Sentiment Index, which has been tracking consumer sentiment for the past 75 years, just hit a record low. This measures American consumers' confidence in the overall health of the economy and is a leading indicator of GDP growth because consumer spending accounts for about 2/3 of US GDP. As to why it's hitting that record low, the survey summarizes that, quote, 57% of respondents cited high prices as eroding their finances, up from 50% the prior month, and supply disruptions in the Strait of Hormuz are pushing gasoline prices higher, and that single line item is doing most of the damage to the household mood. Essentially, cost of living is squeezing the average American, so when consumer sentiment hits a record low, which by the way is lower than what it was during COVID and the 2008 financial crisis, this is the time to pay attention. The Fed projects around a 2.2% GDP growth this year, and hiring is at its slowest pace in over a decade outside of the pandemic. The stock market, on the other hand, has been growing very steadily over the past few years, and it's expected that the S&P 500 earnings will grow somewhere between 17 to 24% this year. In Q1 of 2026, 84% of companies in the stock market beat their earnings estimates, which is the highest rate since 2021. So the economy and the stock market could not be more disconnected as of right now, but here's what you should really know about the S&P 500. The top 10 stocks make up close to 40% of the entire index now. Since this is the highest concentration ever recorded, this is something to pay attention to. So at the height of the dot-com bubble back in 2000, the top 10 companies made up about 26% of the S&P 500. And today, well, I just shared with you, it's about 40%. Nvidia and Apple both make up 7% of the index for a total of 14% between just two companies. So when you hear that the headlines of the S&P 500 just hit a record high, what you should actually think about or interpret is that a handful of AI companies are having a good day when that happens. And these top 10 companies can actually mislead you to believe that the entire stock market is ripping overall, when in fact the other 490 stocks could be having a completely mediocre year, and as long as the top names keep ripping, the headline is still gonna read record highs. Then the question I naturally had in my head after learning this is, what is actually driving these 10 companies, the top 10, to the proverbial moon? Now the answer might be obvious to you, or it might not be depending on who you are, but if you look at the top 10 companies, most of them, I would say 9 out of 10 of them, besides Berkshire Hathaway, have something to do with AI or technology. And that's where capital expenditures come into play. So CapEx, as it's known for short, is the money that a business will spend to acquire, upgrade, or maintain long-term physical assets, such as property, buildings, equipment, or technology. That's the literal definition. And capital expenditures for most corporations, especially the big hyperscaling corporations like Amazon, Microsoft, Alphabet, Meta, and Oracle, they are all at record numbers. This year, a handful of companies are expected to spend roughly $800 billion, even upwards to $1 trillion on CapEx alone. So that means they're spending money on things like data infrastructure, data centers, chips, power infrastructure, and memory. To put $800 billion in perspective, the entire GDP of Sweden is around $760 billion, so 5 companies are spending more than the entire country of Sweden on mostly buildings filled with NVIDIA chips. And I think that's something that's really not often talked about, which is that we all know that we're spending a lot of money on AI infrastructure in the United States, but the scale at which we're spending is literally crazy. It's like if you were a citizen of Sweden and all of a sudden the government came to you and said, you know what, instead of everything that you're spending money on in Sweden, for example, your food, your transportation, or your discretionary income, For this year and following years, we're just going to spend all of that money on AI. Now, here's where this video gets a little bit weird, and I have to correct something that I just implied a few minutes ago, which was that I told you that the market and the economy are disconnected. And this is pretty true, but AI spending is so huge these days that it's actually showing up in GDP numbers. Analysts who broke down the Bureau of Economic Analysis's Q1 GDP data, they estimate that AI-related CapEx was responsible for roughly 3/4 of all US economic growth. If you were to strip out AI spending, the growth would have been roughly 0.5%, which is, I guess, technically still growing, but it's closer to flat. So when a data center gets built, GDP will count it as growth the same way that it would count your raise at your job. And that's a scary statistic because we can't really look at GDP anymore the same way. This is also why you probably feel like the economy is stagnant when the news says that it's growing, and you're not actually wrong here. You might be measuring how your paychecks are coming in, but the GDP number is actually measuring the data center spending itself. And this same inflation in the GDP that's happening is actually stagnating the job market because hiring is way down this year because tech companies are shifting budget away from headcount and towards AI. You can see this frustration among college grads who are now increasingly more irritated by AI because entry-level hiring is down 6% year over year. So there is actual proof that even companies who are hiring have no incentive to bring on entry-level workers when they can have AI do the job instead. So while this is just a state of what's going on in the United States right now, we now have to think, with all of this spending and growth of corporate profits, who are the actual winners of this game? Who's keeping the gains here? Because if gains were spread evenly among the population, then record highs in the stock market would be great news for everyone, and this video would probably not exist. But as you can deduce, this is not actually the case. The gains are not actually spread evenly. The top 1% of Americans by wealth, they own 50% of all stocks, and that's about $27.6 trillion per the most recent Federal Reserve data. The top 10% of Americans hold more than 87%, so that means the bottom 90% in this country, or 9 out of 10 people, they will split the remaining 13% of the stock market. And the most alarming statistic here is that the bottom 50% of Americans, they only own 1% of the stock market. While you will see figures of many Americans owning stocks in general, for example, 58% of Americans own stock, that is technically true, but they simply just don't own enough stock. The median family that owns stock holds about $52,000 worth. That's it, and that includes retirement account balances. So if the market goes up 10%, which is roughly what the S&P 500 has produced so far this year, the median family might see an increase in their wealth of $5,200, which is 10% of $52,000, and it's probably going to be in a 401k. Meanwhile, that same 10% return for the top 1% of Americans represents $2.7 trillion in total wealth. So while we are hitting these record highs, these are going to produce very different realities depending on who you are. And this is why a record high can happen every few weeks, and it still feels irrelevant to how you are personally doing at home. The median family in America, their wealth isn't actually held in stocks. It's mostly in the home that they own, and that comprises the majority of their net worth. A house is not very liquid and does not appreciate as quickly as stocks. Now, if you're sitting in your house right now and you want to sell it tomorrow, it's likely that you're not going to get money for your house tomorrow. It's not very liquid. You still have to list it with a realtor. You have to do all the inspections. You have to agree to purchasing terms. Then the money has to go into escrow, etc., etc. All this stuff probably takes you at least 30 to 60 days at the fastest, and more often than not, you will be tied to your home for a very long time so long as you have a mortgage on it. The top 1%, on the other hand, a home might just be a small percentage of their portfolio, and when you have a lot of capital in your brokerage account or in your stock accounts, record highs in the market are going to be felt much more quickly and realized for various activities, including consumption. And that's something we need to talk about, which is that the gains sitting in the top 10% of American brokerages, they will get spent, and that spending can literally hold up our economy. Economists will call this the K-shaped economy, and you can see with this graphic that purchasing power is going to be on the y-axis here. And for high earners, their purchasing power is going up and to the right versus low earners are going down and to the right. In other words, the gap between low and high earners is widening, and Mark Zandi, the chief economist at Moody's Analytics, has stated that the top 20% of all households, which means that they earn around $175,000 per year, they now account for nearly 60% of all consumer spending, and he himself calls that statistic astounding. And you can see the two lines are moving in opposite directions. And here's another interesting stat. The top 20%, their spending grew 6.5% year over year, which is comfortably beating inflation. The bottom 80%, their spending grew 2.6%, losing to inflation, which basically means in real terms that the bottom 80% in this country is spending flat to negative year over year. So the entire growth in the American consumption or American consumer is at the top. The typical top 10% American has had their brokerage account balance go from $624K at the end of 2022 to over $1.1 million as of late 2025. So in a span of 3 years, a top 10% American might have an extra $500K sitting in their brokerage accounts, and this is leading to them going on vacation more, buying new cars, and not even checking the prices of groceries. In other words, this is causing the disconnection of our society that you're seeing. Now let's talk about the data at the bottom of the K, because this is where the data really reflects the current vibe in the economy. First, real average hourly earnings fell 0.3% over the past year, while CPI is still increasing. So in other words, people are earning less, but prices are still going up. Second, gas from the Iran crisis is now up to $4.12 in June, which is up from $3.14 a year ago. Third, personal savings rates are down. I believe it's under 3% now. And fourth and fifth are the fact that the total household and auto debts, they're hitting record highs, and auto loan delinquencies are the highest ever recorded. Also, if you're young or just not making a very high wage and you feel like the economy is rigged against you specifically, the data says that ages 18 to 29 absorb the strain worse than anyone else. So for example, in terms of delinquencies, it's roughly double a year ago for this age group, which is the worst of all the age groups. So this is actually pointing to some economists wanting to rename the K-shaped economy to an E-shaped economy, which is a brand new shape. The E-shape refers to 3 prongs. The top continues to pull away, same as in the K-shaped economy. The bottom visibly falls behind here as well, but the middle prong is new. According to this article, quote, spending behaviors among middle-class Americans is where you start to see some signs of the affordability crisis. They're still spending on their necessities in some discretionary categories, but the middle class is treading water so they can still pay their bills, she says. And here's why this E matters more than the K. So in the K-shaped economy, the middle class is the stabilizer. The top can splurge, the bottom can struggle, but the middle keeps their spending steady. And this steadiness of spending ensures that the entire economy won't topple over overnight. Historically, steady middle-class spending is what kept downturns from spiraling out of control. But in the E-shaped economy, the middle class is treading water, which means that they are one bad quarter away from cutting spending even further. So right now, that means the majority of consumer spending is reliant on the top 20%, and they're spending because, as we have figured out, their portfolios have increased a lot in the past 3 years. So there's a lot of risks here, and that brings me to my next section, the 3 biggest risks to the economy right now. And the first is that the economy is slowly being centered to one trade, and the spending is being powered by stock gains, and those stock gains are being powered by AI companies. Then the entire economy is coming down to AI CapEx spending. If wealthy consumers pull back their spending, the rest of American households might not be able to help keep those numbers steady. Risk number 2 is that the CapEx math actually has to work. So Allianz research found that the gap between AI capital spending and actual AI revenue is around 46%. That means the spending isn't scaling the underlying revenue at exactly the same pace quite yet. During the dot-com bubble, the same gap peaked at around 32%. So if revenue doesn't show up as quickly as the AI companies can spend the money, that could pose an issue down the line. And risk number 3 is that the Federal Reserve could still raise rates this year. So as of July, the market is pricing in roughly a 75% odds that there's going to be one more hike by December. I'm not here to tell you there will be a crash because I genuinely don't know, and no one out there knows either. I know this video has had a lot of doom and gloom so far, but what I'm just sharing is that the structure of the current market is heavily concentrated around the gains driven by AI spending. And if that spending doesn't amount to real revenue, that could mean we could see a significant pullback in the market, which could in turn affect the GDP numbers. This brings us to the only question that actually matters now, which is what do we do with all of this information? The takeaway I have for you is that everything that we've talked about in this video so far, including the fact that the top 20% of Americans spend the most, or the K-shaped economy, or the fact that a 10% gain in the market represents $2.7 trillion of wealth, It all runs on one single idea, which is that wealth is basically tied to ownership. In today's world, you must have ownership of something in order to get yourself into the top 50 or the top 20 or the top 10% of the country. The economy works by transferring wealth towards people who own the companies which are impacting the market. And so what I want you to take away is that you need to get involved in ownership as soon as you can. A Roth IRA, for example, that takes 10 minutes to open. Index funds cost essentially nothing to own on a yearly basis, and there is no minimum to start these days. It's not like stocks are being kept behind some sort of password protected gate either. You can easily access them through any brokerage app as long as you have the willingness to do so. So the play is exactly what I've shared on this channel before, which is that first, you can only focus on what you can control. Saving your money and investing the difference between what you spend and what you make is always going to be a good strategy because you can't do anything about the K-shaped economy. Sure, you can acknowledge that it exists, but you can't alone control CPI, you can't control gas prices, hiring freezes, or Nvidia's earnings reports. So at least at the very bare minimum, make sure you own some assets. Second, you want to own the boring investments of index funds. So yes, while 10 companies do make up 40% of the index, that's the argument for investing in index funds, not against them. The top 10 companies in 2010 looked a lot different than the top 10 today. So if you buy an index fund, at least you don't have to guess who wins in the following decade. As long as you buy the index fund, whoever turns out to be in the top 10, you just own it automatically. And my third takeaway here is that you want to make sure you have a buffer. Since the national savings rate is under 3%, the average American is probably saving 3 cents out of every dollar. And if they're doing that, that means they never can build a safety buffer or an emergency fund. They never have a cushion, and that's how they end up in these problematic situations where they might have to default on a loan or basically give up their car. I think you should always make sure you have an emergency fund before you invest, and that should always be the case. The headline of stocks pushing record highs is always going to be there. In fact, it happens about 20 to 22 times per year. And so you just need to understand that this machine doesn't really stop. The only thing that changes is whether it's working for you or not working for you at all. And you actually get to choose if it does or doesn't by investing or actively participating in the market. All right, let me know what you guys thought of this video in the comments. How are you feeling about the economy? How are you feeling about the stock market? I would love to hear from you. If you're trying to invest in the stock market and you've never done it before, or perhaps you are someone who is seasoned and just wants a refresher, you want to check out my video right here, my full investing guide on how to invest in stocks. It's one of my best videos on the channel, and I hope to see you in there. Once again, thanks for watching. I know that this video was a little bit depressing, but hopefully it's not always going to be that way. I will see you in a future video on the channel, and thanks for being here. All right, peace.